Hi, welcome back to chapter 10. And in this chapter, we're going to address property, plant, and equipment, and intangible assets. And specifically, we're going to address acquisition perspective. So, in a nutshell, this is the first chapter that we're going to talk about long-term assets and in regarding its measurement and reporting issues. And also these assets are the tangible assets that are used in the goods and services and also cover the valuation of its acquisition. Okay, as we just mentioned that the assets, the long-term financial reporting purpose, the long-lived revenue producing asset is typically classified into two different categories. PPE, which is property, plant, and equipment category, or intangible category. And then in this category, in the first PPE categories, we including land, building, equipment, machinery, furniture, automobile, and trucks. And we also including natural resources such as oil and gas deposits, timber tracts, and mineral deposits. And then in terms of intangible assets, we usually talk about patent, copyrights, trademarks, and franchise and goodwills. And then this chapter is going to touch on all of these assets. And then this is just the first note disclosure of the financial statements and show you guys how it look like in the financial statements. Usually company gonna give a summary of a PPE and the cost of accumulated depreciation. As you can see, they were listing out all those fixed assets the company has, and then the total value of the asset, and comparably usually is 3 years. And they also will listing on the intangible assets and then give you a final number, right? Okay. So first of all, the most important thing in the long-term asset chapter, first concept is that what kind of cost can be capitalized. And the capitalized, we know that the purchase price definitely should be capitalized. Then what about self-constructed products, machine, or donated machine, or machine or equipment coming from business combination, or the leased machine or exchanged machine? How do we consider those different channel of acquisition? How, and then during this process, what kind of costs can be categorized as capitalized? And then in nutshell, the initial cost of the long-term asset is going to be the purchase price plus all expenditure necessary to bring the asset to its desired condition and location for use. Let's see. So what is the cost of equipment? Which is we most familiar with equipment. It will including the purchase cost and any sales tax, and the transportation cost and expenditure for installation and testing, and the legal fees to establish the title under your company, and any other costs to bring the asset to its condition or location for its use. And the sum of all these costs representing the initial amount to be capitalized or recorded as an asset on the book balance sheet. Let's look at this example. Central Machine Tools purchased the industrial equipment to be used in the manufacturing process. The purchase price is $62,000, and Central paid a freight company about $1,000 to transfer the equipment to its plant location, plus $300 shipping insurance. And in addition, the equipment had to be installed and mounted to a special platform built specifically for the equipment at a cost of $1,200. After installation, several trials runs were made to ensure the proper operation. The cost of these trials, including wasted material, about $600. So we say that the equipment to get it ready for intended purpose and location is gonna including the freight charge, and including the insurance that paid on the way, and also installation, testing fee, and also the materials that used during the testing stage. Hence that the cost can be capitalized on this equipment should be 65,100, right? Instead of 62,000 the purchase price. Okay, so cost of land. This is not unfamiliar, right? Cost of land, first of all, including the purchase price, also the attorney fees that help you to get the title, and the real estate agent's commission also can be capitalized as the land of price of land, and costs related to title and title search, and recording fees at the local government, and any back taxes. Back taxes or something like the prior owner actually owe taxes, then you have to pay it in order to retain the title. So those kind of back taxes, once you paid for it, right, then that's gonna be part of the cost of land. Liens against the land, mortgages against the land, or any other obligations. And the current portion of property tax are not included. Okay, this is important. And also expenditures such as cleaning, filling, draining, and even removing the old buildings, those costs can all park under the land costs. So, but remember, if you have an old building on top of a land and you want to tear down the building, some of the material can be used. We call it salvaged material. And those salvaged material can be sold, and then the proceeds of those sold salvages can reduce the cost of the land. Okay, so let's look at this example. So the buyer's Structure Metal Company purchased a 6-acre tract of land and an existing building for $500,000. The company plans to remove the old building and construct a new office building on the site. In addition to the purchase price, the company made the following expenditure at the closing of the purchase. First, a title insurance paid for $3,000, commission paid for $16,000, and property tax is a $6,000. And then the property tax is including $4,000 of delinquished taxes paid by buyer on behalf of seller, and $2,000 attributable to the portion of a current physical year after the purchase date. Okay, we talk about the current taxes does not including in the cost of land, right? So that means only $4,000 can be parked at the capitalized. So shortly after closing, buyer paid a contract of $10,000 to tear down the old building and remove from the site, and an additional $5,000 was paid to grade the land. So how much the cost of the land then? So the cost of the land is like this. First of all, the purchase price of $500,000 is definitely, title insurance definitely included, and the commission are definitely included. Delinquent property tax, like we discussed, although it's paid for $6,000, but we're excluding that $2,000 for current property tax, right? Cost of removing the land is $10,000, and the cost of grading is $5,000. So the total cost of the land become $538,000. Okay, yeah. So the reason we're only including $4,000 is because the $2,000 is related to current tax liability. Okay. So, and then land improvement. So how do we capitalize land improvement? It's important to distinguish the cost of land and land of improvement, because land has an indefinite life, but land improvement usually have a useful life. Okay. And that are estimatable, right? So example of land improvement including cost of establishing like parking lots or driveways or private roads, and the cost of fences and on the lawns, or you put a lawns or garden sprinkling systems. And the cost of this asset, first of all, can be separately identified and capitalized from the land, right? Second of all, it can be depreciated over periods, benefit for their use, such as cost of parking lots, driveway, private roads, fences, and sprinkle systems. And okay, so how do we capitalize cost of buildings? We talk about machine, we talk about land, now we talk about buildings. So first of all, cost of a building, first of all, cost of acquiring a building usually includes the purchase price, realtor's commission and legal fees, and reconditioning costs. And then reconditioning cost is a lot of things, right? So such as refurbishing, remodeling, or otherwise modifying a suit the needs of the new owners. Okay, so the cost of acquiring the building, quite often a building must be remodeled, hence that the remodeling fee can be part of your newly acquired building. That's a good deal, right? Because you can put it on the balance sheets. Okay, so cost of natural resources is also a tangible asset and a long-term asset, and how do we categorize them, right? So natural resources that provide a long-term benefits are reported as a property, plant, and equipment category. This includes things such as timber tracts, mineral deposits, oil and gas deposits. They can be distinguished from other assets by the fact that their benefits are derived from their physical consumption. For example, a mineral deposits are physically diminishing as the mineral are extracted from the ground and either sold or used in the production process. On the contrary, the machine, land, and building produce benefit for companies through their use in the production of goods and services. So unlike the natural resources, their physical characteristics usually remain unchanged during the useful years, right? Yeah. So therefore, initial evaluation is simply the purchase price plus any other costs simply necessarily to bring the asset to condition and location for its own usage, such as if you purchase it, we wanted to include in purchase price or any cost necessary to make it become useful. And if you are internally developed, right, so there will be acquisition costs. First, let's say oil field, you have to buy that land and then you have to explore the land. So the exploration costs such as drilling a well or excavating a mine or any cost of searching for the natural resources. And development costs are incurred after the resource has been discovered, but before it can produce the oil, right? So that's the developing cost. And then including such as expenditure for the tunnel, well, shafts, and the restoration cost, including the cost that to restore the land and or other property to its original condition after you use up the natural resources. So, for example, usually the restoration costs happen after the production begins, such as you wanted to make sure the extracted mineral ground is going to be a big hole, and you're going to fill up the hole and then make sure it's usable for recreation purpose or future farming purpose. So that's what the cost of nature resources. On the other hand, the cost of heavy equipment and other assets of a company uses during the drilling and excavation usually are not considered as a part of natural resources costs. Instead, they can be considered as a depreciable PP&E equipment, right? However, if an asset is used in development of a natural resources, cannot be moved or cannot have any other alternative uses, and its depreciable life is limited by the life of the natural resource, and this kind of a machine can be considered as part of development cost. And then let's look at we kind of mentioned a retirement, right? Kind of like restoration. So let's look at what is the asset retirement obligation. This is a new concept. So a company may incur obligation associated with the disposition of a PP&E equipment and natural resources. This gives rise to an asset retirement obligation, which is defined as an existing legal obligation associated with the disposition or retirement of tangible or long-lived assets. The example can be oil and gas exploration company might need to require to restore the land to its original condition after extraction is completed. So the GAAP requires that an existing legal obligation associated with the retirement of intangible or long-lived asset to be recognized as a liability and measured at the fair value if value can be reasonably estimated. So let's look at what is the asset retirement obligation. So for first of all, let's consider some of a provision of the standard that addresses this obligation. First of all, scope. Asset retirement obligation arise only from legal obligation associated with retirement of tangible loan retirement of long-lived asset that result from acquisition, construction, and development. And then to recognize it, a retirement obligation might be arise at the inception of asset life. Or during its operation life. For example, an offshore oil gas production facility typically incurs its removal obligation when it's begin to operating. On the other hand, a landfill or mine operation might incur a reclamation obligation gradually over the life of the asset as the space is consumed by the waste and a mine extravagated. And the measurement itself is a company should recognize the fair value of the ARO, right? And in the period of its incurred, the amount of the liability increase the valuation of related assets. Usually, at the fair value is estimated by calculating the present value of estimated future cash outflows. And the present value calculation. So traditionally, the way where uncertain has been considered in the present value calculation has been discounting the best estimated future cash flow. So we were discounting the future cash flow, applying a discount rate that has been adjusted to reflecting the uncertainty and risk of those cash flows. That is not the approach that we take here, okay? Instead, we follow the approach described in FASB Concept Statement 7, and which is to adjust, which is to adjust the cash flow, not the discount rate, for the uncertainty of the risk those cash flow. The expected cash flow approach incorporates the specific probability of cash flow into the analysis. We use a discount rate equal to credit adjusted risk-free rate. So basically, we adjust future cash flow based on probability, and the discount rate is equals to a credit adjusted free rate. Okay, and the higher companies are credit risk, the higher will be the discount rate, or other uncertainty of risk are incorporated in the cash flow probability. So let's look at this example. Okay, so the Jackson Mine Company had $1 million for the right to explore a coal deposit for 500 acres of land in Pennsylvania. The cost of exploring the coal deposit is totaled $800,000, and the intangible development costs incurred in digging, erecting the mine shaft were $500,000. In addition, Jackson purchased a new excavation equipment for the project at a cost of $600,000. After the coal is removed from the site, the equipment will be sold. Jackson is required by its contract to restore the land and to the condition suitable for recreation use after its extraction of the coal. The company has provided following 3 cash flow possibilities for the restoration cost to be paid in 3 years after extraction is completed. So the possibility of A possibility is the cash outflow is the 30%, B possibility is the $600,000 out cash flow, and then the probability is 50%. And C is a $700,000 cash outflow, and the probability is only 20%. And the company's credit adjusted risk-free rate is about 8%. So how do we calculate the asset requirement obligation of this company? So it's easy, okay? So first of all, the present value of expected cash flow for the restoration cost, we wanted to use the weighted cash outflow, meaning that we consider three possibility by weighting, use the probability of each possibility, right? So the 500,000 outflow is 150, and then 600,000 multiple 50 is 300,000, 700 multiple 20% is 140, and then adding up is probably about $590,000 cash outflow. And then because it's 3 years from now and the risk-free rate is 8%, so the present value factor is 0.79383, hence the cost is 468,360. And this cost is going to be included in the capitalization of the coal deposit, because restoration costs need to be included in the initial cost consideration. Okay. So the total capitalization of a coal deposit is the sum of the purchase price, sum of exploration price, and some adding the development cost and restoration cost. And then when we journal it, we want to debit a coal mine of this 2,768,360, and then we will pay for cash for all those purchase, exploration, and development costs. And then we will record an asset retirement liability of 468,360, because this is going to be a cash outflow in 3 years, right? Right, and then regarding the equipment that we use to help the excavation, then that will be a separate PP&E assets. We debit excavation equipment and we credit cash. And then, as you know, that the obligation of 468,000 will grow over time because there's an interest rate. Hence, that we will have to accrue expenses along the way until the day that we're spending at the present. This is the present value of the obligation on the end of year 3. The obligation will grow to 590,000 because each year we have a credit adjusted free rate of 8% multiplied on top of what is our retirement obligation. Hence, that in year 1, during the period accretion expenses will be 37,469, and then these expenses will be adding on top of the liability that we have originally created to increase liability from 468,360 to 505,820, so on and so forth. So therefore, for example, the first year that we do is we will debit creation expenses and credit the asset retirement liability for 37,496.69, because this is a liability. Once you have a long-term liability, have a risk-free rate, then that means that you have incur a periodic cost, right, which is going to be on the income statement. And then the credit side is going to be increasing the ARO obligation. Okay, so at the end of the year, let's say if actual restoration costs are more or less than the 590,000, that is the future value of 468,360 at the 8%, n equals 3, right? I equals 8%. If the actual restoration cost is higher than 590, then you will incur a loss, which is this situation, because in the end you really paid $625,000 to retire the asset. So that means that you incur a loss of $35,000. Okay, so now let's look into the intangible assets portion. And the intangible assets are assets other than financial assets that are lack of physical substance, and they including items such as the patents, copyright, trademarks, franchise, goodwills. Despite of lack of physical substance, this asset can be extremely valuable to a company. In general, intangible assets refers to the ownership of exclusive right that provide benefits to the owner in the production of goods and services. And companies acquire intangible assets in two ways, right? So first of all, it's very difficult to anticipate the timing and existence of a future benefits attributed to many intangible assets. So in order to obtain intangible asset, either company can purchase an intangible asset or it can develop an intangible asset internally. If you purchase intangible asset from other entities such as patent, copyright, and trademark, and when you internally develop something, you can develop a new product, then you can get patent. And then, so we call the depreciation, we call the expenses towards the PP&E assets called depreciation, but we call the cost incurred periodically for intangible asset amortization. So therefore, there's a two kind of intangible assets. One kind is a finite life, hence that we will amortize we will incur amortization expenses for the finite useful life intangible assets. For those that had an infinite useful life, then we will not amortize. And then the cost of acquisition intangible assets is going to be the purchase price plus all other costs necessary to get the assets ready to use, right? Similar as the tangible assets. So let's briefly look at this graph, like what kind of assets are out there. So in this book, we focus on 4: patent, copyright, trademark, and franchise. So patent means the exclusive right to manufacturing a product or using a process. And it's granted by US Patent and Trademark Office for only 20 years of a finite life. And the cost can be capitalized under the patent, is including the purchase price, legal fees, filing fees, not including internal research R&D expenses. And the copyright almost similar as patent. It's a copyright means exclusive right for production given to a creator of a published work, such as songs, films, and books. And it's granted by U.S. Copyright Office for the title for the life of the creator plus 70 years beyond his life. And the cost including purchase price, legal fees, filing fees, not including R&D expenses. Trademark. Trademark is the right to display a logo, a slogan, or word or symbol that distinctly identifies a company's products or services. And then it has to be registered with the U.S. Patent and Trademark Office, and it has a useful life of 10 years. And then the cost to use those be capitalized under trademark, including purchase price, legal fees, filing fees, not including R&D expenses. And franchise is the exclusive right by franchisor to franchisee to use a franchisor's trademark and products. And franchisor can grant it for a specific time to the franchisee. And the costs should include initial payment plus periodic payments over the life of the franchise agreement and any legal costs associated with the contract. Okay, so this last category of the intangible asset in financial accounting, we didn't really talk too much about the goodwill, but here we wanted to emphasize on the goodwill. So goodwill is a unique intangible asset that is its cost cannot be directly associated with any specifically identifiable rights, and is not separable from the company itself, right? And goodwill can emerging from companies' clientele or favorable business location, training employee and management team, and the reputation, firm's reputation. and any other unique feature about a company that hasn't been able to associate with or pin down to any kind of specific asset, we can consider it as a goodwill. Okay, so because the goodwill cannot be separate from a company, it's not possible for a buyer to acquire it without also acquiring the whole company, right? Or portion of the company. So therefore, in order to calculate the capitalization of the cost of goodwill, we wanted to use the following formula. Basically, we want to use the fair value of the consideration given in exchanging for the company, which we call the acquisition price, minus the fair value of identifiable net asset acquired. And the fair value of the all identifiable asset, net asset is actually equals to the all identifiable tangible and intangible asset minus the fair value of liability of the selling company. Let's look at this example. The Smithson Corporation acquired all of outstanding common stocks of Ryder Corporation in exchanging for its $180 million cash. The Smithson assumed all Ryder's long-term liability, which have a fair value of $120 million at the date of acquisition. Okay, so and then the fair values of all identifiable assets of the Ryder are as follows. They have a receivable of 50 million, inventory of 70 million, PP&E of 90 million, and patent of 40 million. So hence that the cost of goodwill is going to be the fair value of the consideration given, right? And then minus the fair value of identifiable net assets acquired, such as fair value of identifiable asset is going to be 250 because of 50 plus 70 plus 40 plus 90. And then we have to reduce the fair value of the liability assumed, which is 120. So the net asset of fair value of the acquired company is going to be 130. So therefore, the extra $50 that the acquisition company is paying is $50 million more. And then we categorize this as the capitalization of goodwill. And then so therefore, the journal entry of this M&A requisition journal entry will be you were taking over all the assets that you buy, right? Debit all the receivables from acquiree, like a receivable, inventory, PP&E, and patent. And then you will also take over all the liability of acquiree, which is credit 120. And then you are crediting out in your cash outflow of 180. So the difference will park under the goodwill, which is you have a new class of asset, intangible asset, goodwill, for $50 million. Okay, and now we wanted to talk about the lump sum purchase, which I don't think you guys are foreign, right? Because we kind of talk about the basket purchase in the financial accounting. So in other words, it's not unusual for a group of assets to be acquired for a single sum. If these assets are indistinguishable, for example, 10 identical delivery trucks purchased in a lump sum price of $150,000, then the valuation is very easy. Each truck would be valued at $15,000, right? Because you use 150 dividing 10. But however, if an asset has different characteristics and different useful life, then acquisition of the lump sum, a lot of assets together, such as including building, land, and equipment, then we wanted to use the following method. We wanted to allocate a lump sum acquisition price among the separate items. Okay. So what we do is that we wanted to use the fair value of each asset class and then figure out what is the proportion of that class towards as dividing the total fair value of the whole assets, which is going to be land is going to be 15%, and building 25%, equipment 30%, patent 20%, and the inventory 10%. So therefore, then using that proportion to multiply the consideration paid, which is $2 million, which result in a initial valuation of each asset will be land is gonna allocate about 300,000, building gonna be 500,000, equipment gonna be 600,000, and patent gonna be 400,000, and inventory $200,000. And then what we record is we're gonna debiting land, building, equipment, patent, inventory, and crediting cash or 2 million by using this allocation base to split the basket purchase, right, among different class of assets. But the key here is that this percentage is based on fair value percentage, right, not book value. Okay. So now I wanted to look into the non-cash acquisition. Okay, so when you buy things that it did not involve cash, then what do we do? So sometimes the company acquire assets without paying any cash at the time of purchase. We examine 4 situations, such as deferred payment situation. Basically, you issue a debt to buying the asset, hence you didn't pay out the cash immediately. Or you can issue equity to buy the asset, or it's donated asset, right? It didn't pay for any consideration, or it's exchanging another assets, non-monetary asset for that assets. So the assets required in non-cash transaction are valued at the fair value of the assets given, or fair value of assets received. So in other words, in the non-cash non-cash in exchanging consideration, all the acquired assets are being evaluated at the fair value, okay, whichever is more clear. So let's look at this one. So an obligation to make payment in the future, which is a deferred payment, right? So, and the machine is acquired for $15,000, and the buyer signs a note to require the payment of $15,000 sometimes in the future, plus the interest at a realistic interest rate. So therefore, you debit machine for $15,000, you credit note payable for $15,000, and then let's look at another more complicated. So this case is that the company can acquire an asset by giving a seller a promissory note to pay cash in the future, and thus creating a liability such as notes payable, right? And the initial evaluation is quite simple, as long as the note payable is explicitly require payment of interest at a realistic interest rate. And but let's look at a little bit more complex situation. So on January 2nd, the Midwestern Steam Gas Corporation purchased industrial equipment. In the payment, Midwestern signed a non-interest-bearing note requiring $50,000 to be paid on December 31st, 2022, which is 2 years later. If a Midwestern had borrowed cash to buy the equipment, the bank would have required the interest rate being 10%. So therefore, what is really cost towards the Midwestern company in terms of purchase this equipment? On the surface, it might appear that the Midwestern is paying $50,000 for the equipment and the eventual cash, and that's exactly the eventual cash outflow. However, when you recognize that agreement, the specification, it says it's no interest, right? Even though the payment won't be made after 2 years, right? That's a little bit odd, and hence that it becomes very obvious that the portion of the $50,000 payment is not actually the payment for the equipment right now, right? It's a future value of a $50,000, but instead there's some sort of interest get wrapped up in this $50,000. And so therefore the question is, how much is the equipment really worth today, right? So if I ask you this question, you remember to use a chapter, I think it's 7, the present value and annuity and stuff like that, and you can figure out what is the present value of this this equipment. So simply, right, the present value should just use a $50,000 2 years from now. multiple that simple present value of $1 rate is at 10%, and then n equals 2. So that means the fair value of the equipment today, if I pay for it, it will be $41,323. But since I promised to pay in 2 years later for $50,000, so that means that the difference here, we want to call it a discount on notes payable. So in other one, means that it is this might be the amount that actually paid for the equipment, then it is actually fair value of the cash flow. Hence that the difference between the present value and the future value, it's gonna be similar as issuing a bond, right? Called a discount on bonds or discount on notes payable. And then the journal entry in the physical year and for the first year, of course, you're gonna record the interest expenses because the carrying value of the notes is 41,000 and the interest rate is 10%. And then that way you were debiting interest expenses, crediting discount. Hence, the carrying value of the note is increased for 4,132. And the second year, you will have a much higher carrying value because you're adding 4,132 on top of that bigger carrying value at the beginning. So therefore, your interest expenses are gonna grow to 4,545, and then you're gonna credit the down discount on note payable 4,545. And then, as you can see, the last, and also on the end of year 2, you're gonna pay for the notes payable that you promised, which is a face value of 50,000, and credit out cash for 50,000. So if you look at the T account, you will see that interest expenses is actually for each year there's about $4,000 flow to the income statement, right, to carrying these notes. On the same time, the discount on notes payable is actually increasing the carrying value of the notes payable. Hence, it grow from 41,323 at face value to $50,000 in the end. The logic in short is exactly same as bond issuance, right? Okay, so we actually just look at the fair value of the asset is known. How about let's look at let's look at this question. Okay, so on January 2nd, 2021, Danition Inc. purchased a machine and signed a non-interest-bearing note in payment. The note requires companies to pay $100,000 on the December 31st, 2023, which is 2 years later. 3 years later. And the Danition is not sure what interest appropriately reflecting the time value of the money. However, the price list indicate that the machine could have been purchased for cash at the price of $79,000. So this is very straightforward, right? Although you don't know the interest rates, but you know that if you buy machine today, it costs you $79,000. But if you pay machine 3 years later, you got to pay $100,000. So that's the difference between the cash price and the face value of the loan will be the discount on note payable, right? Which is going to be $20,617. So therefore, you can deductively figure out how much is the interest rate by looking at the table, because you remember the present value equals the face value multiple present value factor. The present value factor will be equals the present value dividing future value, which get us present value factor 0.79383. If you look into the present value table of number 2 years, and then you can find the column. I'll just hold on a sec. And you can find the column of the I, right? The I should be 8%. So that's another way to figure out what is the implied borrowing rate of the company if you don't know about it. Okay, implicit rate of interest. Okay. Besides the issue debt to buying assets, we also can use equity to buy an asset by issue in exchanging asset. And then this situation can occur when a small company incorporated and the owner and owners contribute asset to the new corporation in exchanging of ownership security, right? For example, you and your friend wanted to open say gallery, right? And then none of you guys have cash, but you know that you have a property that has not funding useful yet, then you're contributing that property in exchanging ownership of that small gallery, right? So, and then in that case, then how do we calculating the exchanging value, fair value of the asset that we receive in such as that building used as a gallery, and how do we know the market value of shares of corporation whose stock is activated, traded, right? So so first of all, it's a because the common shares are not public traded, such as the first example that you are founder with your friends or open a gallery. It's quite difficult to determine what is the fair value of your contribution to the partnership. In that case, the fair value of the asset received by the corporation is probably better indicator of a transaction's exchanging value. And then in other situations, for example, is involving the public company, such as those companies whose stock is actively traded. That situation is much easier because you can use the market value of the shares in exchange can indicating the fair value of the assets, right? Okay. So let's look at the one example of the public firm example. On March 31st, 2021, Alcon companies issued 10,000 shares of its no-par common stock in exchanging for land. On that day of the transaction, the fair value of the common stocks evidenced by its market price is $20 share. So therefore, the valuation of the land will be $200,000 because 10,000 share multiple 20 per share is $200,000, right? Okay, so then let's look at the third situation we talk about is donated assets. So on several occasions, a company can acquire assets through donation. The donation is usually an enticement to do something that benefits the donor, right? For example, the developer of an industrial park might pay some of the cost of the building a manufacturing facility to entice a company to locate in its park. Like for example, you're building a fountain, and then so the companies come to rent that industrial park will enjoy that fountain without paying for it. And the company can record the asset donated by unrelated party at the fair value based on either there's available market price or there could be appraisal value. And then at the same time, you should record whoever received that donated asset has to be credit and revenue, okay? Because those assets is you getting for free, and then it has to be considered as a revenue to the company, okay? So let's look at an example. Alcon Enterprise decided to relocate its office headquarters to the city of Westmont. The city agreed to pay 20% of the $20 million cost of building the headquarters in order to entice the Alcor to relocate. The building was completed in May 3rd, 2021. Alcor paid its portion of cost of building in cash. Another way talk about is that this building is cost $20 million to build. And then the city, in order to ask Alcon to locate its headquarters into that city, the city says that we pay 20% of the cost and you only need to pay 80% of the cost. But Alcon is going to be the one using the building, right? Hence that the Alcon can debit a building of the full price of 20 million, and then they have to credit in the cash portion of their pay, and then also they have to recognize the revenue of donated portion of the 20%, because this 20% is donated from the city and they receive as a free gifts. hence that it's being considered as part of their revenue for $4 million. Okay, so in other words, asset donation situation is recording the cost of the asset at the fair value, and then recognize the revenue of the donated portion of it. Okay, recognize revenue for the portion that you didn't pay the cash for. Okay. So now let's look at the angle from decision making's angle, which is management angle. Okay. So how did the manager decided whether to purchase intangible or tangible asset? So this decision is among the most significant decision that management must take, right? Because whether it's a PP&E or intangible asset, it's pretty expensive. And the decision to buy a new fleet or airplane or purchase a new office building or manufacturing plant could influence the company's performance for many years. And this decision often referred as a capital budgeting decisions. And it requires management to forecast all the future cash flow that associated with the this asset they are in consideration, right? And this cash flow are then used in a model to determine if the future cash flow, right? It can be the present value of the future cash flow those investments, those planned PP&E and intangible assets can bring, whether it's bigger than my initial acquisition cost, right? These cash flow are then one such model is a net present value model. Companies compares the present value of all future potential cash flow with the initial acquisition cost. If it's bigger than the initial acquisition cost, then that means that this is a good investment. And another way of deciding whether we should acquire an asset is looking at the from a profitability angle, right? And then if we decided to look at it from a profitability angle, then a key to profitability is how well the company's manager utilizing their assets, right? And then you remember there's a ratio called fixed asset turnover ratio. And the financial analysts often use activity or turnover ratio to evaluate companies' effectiveness in managing their assets, right? And this concept was illustrated with a receivable and inventory in previous chapters. And PPE usually are a company's primary revenue generating assets, and their efficient using is very critical to generating a satisfactory return to the owner. So the most important ratio we introduce here is the fixed asset turnover ratio, which equals net sales dividing average fixed assets. And then this ratio is indicate the level of the sales generated by $1 of asset, how much dollar of sales you can generate, right? And this denominator usually is the book value of the assets, and sometimes called the carrying value of the assets, which is the cost minus the accumulated depreciation. Furthermore, it is the average, and also don't forget it's the average of the book value of the asset, which is equals the beginning book value plus ending book value dividing 2. Okay, as I just said, the book value is sometimes equals to the also can be called the carrying value, is equals the cost minus accumulated depreciation. So let's give you an example. Then PP&E, net PP&E is 2,805 million, and then 2018 is 2,616, and net sales is $15,000. So another store is called a Rose store. They have a different ratio. And then let's look at the fixed asset turnover ratio for GAAP. You will use the net sales, which is 15,855, dividing the average of 2005-05 and the 2006-16, which is 2,710.5, and the asset turnover ratio is 5.85. And comparably speaking, the Ross store is a 6, right? So basically, meaning that Ross is much efficient in utilizing the asset to generating the sales. Okay, so the next segment of the knowledge of this chapter, we're going to talk about the exchange, right? So sometimes company will acquire a new asset by giving up an existing asset. For example, a company might purchase a new delivery truck by trading in its old trucks, right? And this is referred as a non-monetary asset exchange. Okay, and if the value of those non-monetary assets are not equal to one another, the cash will be received or paid, right? Because if the old asset the fair value is different than the fair value of the new asset acquired, there will be a cash in exchange to make up the difference. And when the old asset plus the cash given up is much higher than the new asset acquired, that will be gain or losses recognized, right? So therefore, gain or losses is recognized in transaction for the difference between the fair value of the book and the fair value and the book value of the asset being given. So here's how we're going to do it. There's a couple basic steps to record the non-monetary asset exchangings. So step 1, record a new asset at fair value, right? Fair value is determined based on the fair value of the asset given up or the fair value of the assets received. In normal exchange, we expect those two fair values are equal. And then second, remove the book value of the non-monetary asset given. So book value equals the recorded cost and minus its accumulated depreciation. And 3, record any cash paid or received during the exchange. Cash is used to equalize the fair value of non-monetary assets in exchange. And 4, record any gain or losses. The gain or losses on exchange equals the difference between the fair value and the book value of the asset given up in step 2. And if the fair value is greater, then the gain is recognized. If the book value that were given up is going to be greater, then the loss is recorded. The gain and losses also can be viewed as a plugged number in the balances on the debit and credit in a journal entry. So let's look at an example. The Alcon company traded its old laser equipment for newer air-cooled iron laser equipment manufactured by American Laser Corporation. The old equipment had a book value of $100,000, which is a cost of $500,000 minus accumulated depreciation for $400,000, and a fair value of $150,000. And Alcon also paid American Laser $430,000 in cash as part of exchange. So how do we do this, right? So another way that so first of all, we wanted to recognize we wanted to look at the asset we are giving up. First is the equipment itself, which is $50,000 as a purchase price, but associated with accumulated depreciation for $400,000. Hence, this two number adds up is $100,000, right? And second, we are giving up cash as well for $430. So the equipment itself new should be recorded as what do you call it? $580,000, right? Because you wanted to use all this difference and then find out the debit side is actually $580,000. And then you find out that you actually had a gain because the equipment new $580, and then you actually giving up the total cost of $530,000. Hence, that you can recognize a gain for $50,000, right? So therefore, fair value of a new machine is the $580,000, and which equals the $150,000 and plus $430,000, right? And then the gain will be the fair value, which is $150 minus the book value of $100,000, which is gonna be $50,000. how did we know the fair value of new equipment? It is equals the fair value of the old machine, right, plus the cash given up, which is 430. So therefore the new machine is worth 580. So that means that we will have a gain of $50,000. Okay. So let's look at a loss situation. What are we going to do in the loss situation? It's almost the same scenario. So Alcon Company traded its old laser equipment for new air-cooled iron laser equipment manufactured by American Laser Corporation. The old machine had a book value of 100,000, which is the cost of 500,000 minus accumulated depreciation, and fair value of 75,000. And Anchor also paid the American Laser $430,000 in cash as a part of exchange. Then what do we do? Of course, we first get rid of the old machine by crediting out the cost and debiting out the accumulated depreciation, and then we credit out the amount that we paid for 430. But the new machine's cost is gonna only be $75,000 plus $430,000, right? Which is $505,000. So $505,000, you find that the debit side is only gonna be 905, and the credit side is gonna be 905, and the credit side is gonna be 930. So that means that the debit side is missing. So therefore, we have recognized a loss on exchange for $25,000. In other words, that the old machine's fair value is actually smaller than its book value. When it's cashed out or in exchange, it's basically meet the market. The market considers it's not worth at what is the book actually said. So therefore, the $25,000 is gonna be the loss of this exchange. Okay. So, and then there's another situation is that non-monetary asset in exchange, but the fair value is not determinant. Then what we're gonna do? We're gonna talk about it in the next video, because I don't want to make this video too long. Thank you.